So what I want to share with you here on this video is what other entities can you put in place to maximize your current company? Now, we see people with leasing companies. We see people with marketing companies separate from their main operating company. We've seen people just with all sorts of different strategies. And some of them I question because I don't understand why they put it in place. I don't see the tax efficiency being created. I don't see the wealth building being created. So one thing we do is we want to make sure that you have different entities that are going to maximize your tax efficiency, but also maximize your wealth creation. And one strategy I want to talk about here is help you mitigate risk. And so this is really what's called a captive insurance company, a closely held insurance company. That's kind of what we hear it called out there. And it's in the tax code. And so really what it is how do you shift your risk to somebody else? How do you that's what insurance is. You're shifting risk and putting it onto another company, and you're paying a service fee or a premium for that risk, but that company is insuring you against a loss, right? So if you look at just a normal insurance, let's look at my household. So we have, I always have the lowest deductible and the highest fees on any insurance that I have because I just like the peace of mind, right? So when you have car insurance, you pay a monthly premium, and you get in a car accident, somebody insures against that, right? So for your business, there's a lot of things that you're not insured for that you could actually pay a monthly premium for and become insured for in your business. So let me give you a couple ideas. You know, one person had a supply chain disruption. They were heavily on fruits from this one part of the world, and that part of the world had a drought. And so their business had a supply chain disruption for that specific fruit they were utilizing. Now, they were able to insure, you can insure against that through supply chain disruption, right? But how do you insure yourself and maybe just create your own closely held insurance company to insure against that? And so, for instance, they could pay a premium that's deductible to their company and put it into a separate company that essentially they own that is insuring their first company, if you will. Now let me explain a couple scenarios here and how this actually works. So one lady was paying $400,000 in workers' compensation premiums. And so that $400,000, as you know, is a tax deduction against your business. It's an insurance premium. You pay that over to Chubb, you pay that over to Farmers, you pay that over to State Farm, you pay that to an insurance company. That insurance company takes that $400,000, puts it in their general account. They invest that in their general account. And then what happens is if you have a claim, they take that money and pay the claim. Now, what they do is spread that risk among hundreds and thousands of people and hundreds and thousands of businesses just like yourself to mitigate that risk. But here's the value, is if you ever look at how Warren Buffett actually got rich, is he bought insurance companies and invested that float. So that $400,000 goes into the float of the insurance company. They get to invest that money. They invest in safe and secure things. But that's why insurance companies are some of the most profitable companies on the planet. And they've made it through every Great Depression and recession. Typically insurance companies do. And so they put that money, they invest that money, so you take that $400,000, you get a deduction on your business, the insurance company gets to invest that money, and God forbid something happens, you get to file a claim against that, against whatever happened, that loss, and the insurance company is going to pay you. So one thing that we do is we put into place what's called a captive insurance company. It's an insurance company that essentially you own. And so by owning this insurance company, you can insure against the risks that you're already paying insurance for. So, you know, think about what are you paying for? You know, I remember one time we were working with a liquor store, 15 liquor stores. They were already paying $140,000 to insure certain risks. Now, they also had about another $150,000 of risks that they weren't insuring for. So there's a lot of risks out there that you are currently insuring for, and then there's risks that you're not insuring for. And so what we can do is we can create what's called a captive insurance company. So you pay the premium into this captive insurance company, which you own, and you are insuring against the risks in your current business and your current operations. Now this money over here, Now, it definitely is earmarked for insurance, okay? Let's not kid ourselves. It has to be underwritten properly. It has to be earmarked for risk, and it has to be managed appropriately by the IRS standards, and we're going to stay in line there. But the great thing is it's a great wealth building tool. So now let's take that first example, that $400,000, you get a tax deduction, and that lady was say she was getting that workers' compensation insurance, just say State Farm because it's a well-known name. So now she had that $400,000, was leaving. She's getting the tax deduction, was leaving. So now what if we take that $400,000, give her the tax deduction, but now put it in her own captive insurance company outlined by the IRS and buy her insurance. Now she has that whole $400,000, which is considered float in this captive insurance company, building wealth for her. Now certainly, if she has an event that she has to file an insurance claim against in her primary business, she could file a claim and be reimbursed for that claim just like she would currently. But now she has this other captive insurance over here that is her company that she is building wealth, just like insurance companies do. Now, I always use the story of the litigator just because it's an interesting story more than anything, is a litigator, when they take on a case, they take on the case pro bono, meaning that if you got in a car accident and hurt your neck, you don't pay the litigator unless you win. So the litigator's not going to take on the case unless they think they could win. However, if they lose, they're out all that time, all that money invested into that case. So now they lose, their business could be at risk. They could have the equivalent of $1 million invested into that case, and if they lose, they're out that $1 million. Well, they can insure against that. Now, certainly there's probably litigation insurance companies out there I just never looked for, but what we were able to do is do a captive insurance company and insure against that litigation risk. So now, let's just say on $6 million, they were able to put $1 million in this captive insurance company. So now they're getting $1 million deduction on their current business. They move it over to this captive insurance company, and they have this $1 million there that they can invest in certain ways as outlined for insurance companies. Now, if they lose a case, they could file a claim and take that money out, or that money's sitting there to build a nice nest egg for them for future use. So you can become self-insured through a captive insurance company and insure the risks that you're currently insuring for, and you can insure beyond the risks that you're currently not insuring for. Because, you know, let's face it, sometimes in insurance, we all make this is the judgment we make. Do I want to pay a lower premium and take on more risk? So that's essentially what a deductible is. We say, okay, I'd rather pay, just use some numbers here, I'd rather pay $200 a month and have a $1,000 deductible rather than pay, say, $300 a month and have a $500 deductible. Now, we all make those judgments. So when we look at things in our business, we say, okay, I'll insure against that because I can see that plausibly happening. I'm not going to insure over here because I can't see that plausibly happening. But maybe you're going to be like Whole Foods was when they first started. They weren't insured in they weren't insured and their first building burned down. We might not even have heard of Whole Foods if that owner wasn't resilient, right? So that we all understand that there's risks in our life that we're not insuring against. But would you insure against that risk if you knew that you could create some tax efficiency and build wealth? So now you're insured against that risk and you're able to build wealth. So instead of, as a business owner, we all have an inherent propensity to take on risk. Well, now you could possibly insure against some of the risks that you know you're taking on and create a better financial situation for yourself by insuring for that risk and possibly creating your own captive insurance company or closely held insurance company. So those are some of the strategies. It's another entity that we could put in place. We could help insure your current business, help it run more efficiently, help it maintain its capitalization, help you with some tax efficiency, help you build wealth also over here. But obviously the main purpose under the IRS is to become insured against those events that either you're currently insuring for or the ones that you're not insured for. But it's a great tool to help you mitigate risk, create some tax efficiency, and build wealth. So there's another strategy that we implement, and when we look at your business, we ultimately say, what are other entities that we could set up to help maximize your business and help you create more financial security?